Welcome back to the Multifamily Investor Playbook. We're going to do things a little different today. We are launching a new deal, Faris Residences Georgetown. So, what I did was I recorded about a 30-minute presentation. So, we built out a full deal deck with that, and I recorded that. And so, John and I are just going to do a quick intro of that deal deck and of that presentation that you're about to watch. But, John, I want to get some high level thoughts from yourself, and then I'll share a little bit of insight as well before we get into the deal deck recording.
Yeah, I think this is really a great opportunity for an investor watching this to really learn not only, kind of like we talk a lot about multifamily investing, our strategies, our underwriting due diligence, et cetera. But now you can see a real live deal, right? And so we get into all the data on our decision making, the business plan, our assumptions, and our pro forma. So, if you're interested in investing, fantastic. But if you're just interested in learning more about these deals, it's really the anatomy of a deal at the end of the day. You can walk through the whole thing and really get a good understanding of not only our approach to investing, but just these types of deals in general. So, a very powerful watch that I'd recommend everybody dive into.
Hey, John, what are the one or two top things that you really like about this opportunity for investors today?
I think for me, there's the first thing is we're buying this at an incredible cost basis. So $100,000 a unit. To put that in context, we bought deals last year at 165,000 a door that it was like a screamer at the time, right? So this is like an exceptionally low cost basis. The average home in that area is trading for about 350,000. So just to put it in context. So that's number one. Number two, all of the units are in classic condition and the building is 100% occupied, meaning that the current owner operator is not pushing rents as aggressively as they could. So when we come in and execute our business plan and renovate these units to Class A standards, we're going to be able to achieve upwards of $409 in rent lift for that renovated unit, which is just absolutely exceptional. So 100% classic and that low cost basis, I think, are the two biggest, daggers I would say for an investor on this deal.
Yeah, that rent lift, I love that. And just if you're listening out there, that means that over $400 on average rental increases per month per unit. So, John, the one thing that we don't talk about in here, and this is a little bit of a sneak peek there, is that there's over $100 operational upside as well, in addition to that $400. So there's a lot of low hanging fruit here. They're all main floor access, so it's great for seniors. Very little low competition in this community as well. And we'll just say the ability to take an asset and to do we'll say a reposition at this level with what we're going to do with their 28-day full out transformation plan and just go in. The before and after of this is going to be really strong. We're looking to do this plan over a 3-year time frame, and we're looking to sell it within 3 to 5 years. So watch the presentation from start to finish. It's going to really give you a good understanding of the entire deal. And if you do have any questions, book a one-on-one call with John or myself. There'll be a link below, and make sure to make your reservation. So spots are filling very quickly, and once they fill, then you'll have to wait for that next deal that comes up. So make sure you make your reservation and book that one-on-one call as soon as possible. Hope you enjoy. We are really excited to be offering this deal in Georgetown, South Carolina. This is a 66 unit apartment value add deal where we're holding on to it for approximately 2 to 5 years. We're going to do a full renovation on it, and then we're looking to sell. And the story on this is that there's a Texas group that currently owns it. We've gone in and we purchased the property. We were in competing situation. It got into a best and final, so it was down to us and a couple of other groups. The two other groups were substantially higher when it came to price. One was about $200,000 higher than us, and the other was $300,000 higher than us in the purchase price. And the reason we got the deal was that we had transacted with this real estate broker in the past on a prior deal that we closed in Charleston, South Carolina. And the broker really believed in our ability to close the deal and to make a stress-free situation for the seller to be able to go in and buy it. And so that relationship allowed us to get this at an exceptional cost basis of $100,000. And this deck is going to give you the full details of the property. So just jumping into the deal, we are first and foremost, disclaimer, we're not a accounting firm or a law firm, so we always recommend that our investors get their own legal counsel here. Quick outline of the presentation. We're going to be going over overview, the team, the market, the property, the business plan, financials, the timeline of when we're actually looking to close, be fully funded by, and then distributions, when those will start, and then we'll talk about next steps moving forward. So at a high level, the top 5 reasons why we really like this deal is that the upside in it is extreme. So there's over $400 in upside rental lift per unit per month. And so it's very rare to find this kind of size of apartment that have, we'll say, all classic units. And so that is a real opportunity in this, that 100% of the units are classics and they need renovation. They're all ground floor access as well, so great for seniors, where this area there is a large portion are retired people that live in Georgetown. And, that's a real value add as well. There's very little local competition. We went and shopped all the surrounding area apartment buildings, and there's just not a lot of competition if you're looking to rent. And the cost basis on this as well, as I mentioned, $100,000 is what we got it for at 20% below market value of the peak. The numbers where they come in at, we acquired the building at $6.625 million, and we're looking to raise just over $5 million in equity on this. Now, we are close to being fully reserved. We had sent an email a few days ago from the time of this recording, and we are almost fully reserved right now. We're looking to get a mortgage of $4.2 million on this. So all-in costs, including soft costs and contingency, is at $9.43 million. Location-wise, it's situated between Myrtle Beach and Charleston. So it is a coastal city, and we do have locked-in insurance that covers not only the full building, if there was any sort of storm or anything with that, is fully covered, and then also rental loss as well is covered on that side. But Georgetown, it's a really quaint town that is approximately 10,000 population, and we are seeing quite a few people actually commuting into Myrtle Beach and Charleston, but it's a beautiful city there. The profit share, this is going to be a little bit different than our prior deals in the sense that we were offering a Class A share. We're holding back 20% of the equity, where we are increasing the cash flow monthly payment. So if cash flow is important for you, then you'll have an opportunity to invest in these Class A shares where you will get a 10% annual return, and that's paid out on monthly distributions, and this is coming from cash flow. The Class B share is something that if you're looking for more appreciation, you're going to participate in the upside of the deal, and you'll have approximately about 6% cash on cash return. So the Class B is an 8% preferred return, and then over 8%, it goes to a 70-30 split, 70 to the investors and 30 to Faris Capital, and only above 15%, there is a 50-50 split. Now, in the Class A shares, there is a 10% preferred return, so you're going to get that first 10%. And if you're looking for more safety and we'll say more consistency when it comes to cash flow, Class A is your option. Class B, if you're looking for appreciation and cash on cash returns. So you can see the breakdown here between the two class shares. You're looking at Class A, so the $10,000 is what will be paid out, and this is return of capital as well, which means that at the end of the year you will not have tax consequence. Not until we sell the asset in 3 to 5 years down the road will you be paying taxes, and then it counts as a capital gain. And the same is true for Class B shares. You could see it starts at about 5%, and then it ramps up as we do more renovations. The cash flow increases to a point where we're doubling the money in 5 years is what we're projecting. The team, of course, is of untold importance. When you're operating these large deals, the operational team I found to be one of the most important things to make sure that the deal goes as expected. And so we are, we'll say, fully supported here with an extremely talented group of individuals. So my background, so I am Canadian. I am living in Florida for the majority of the year. So I do have quick accessibility to these buildings. And we built the largest real estate team in Canada. And so we've worked with thousands of investors through the years. We sold over 13,000 properties, and we do have a strong brand presence in Canada in real estate as well. And so we've had success building teams, successful teams to be able to deliver great results for our clients. John, I had been masterminding with John for about 4 years. He built the largest real estate team with his partner, Mark Spain, in the US, and they scaled up to the largest in US. And so he's very talented when it comes down to building teams. He's more of the integrator. I'm more of a visionary. And so we had partnered up, and we are delivering on this best investing experience in the world mission that we're on. And so we brought on Joe Lowry. So Joe is he's based in the U.S. and has close to about $1 billion in acquisition experience. He has a full cycle deal track record of 34%. And on an annual basis there from internal rate of return standpoint. And then we brought on Georgia as well. So Georgia has over 20 years experience, has gone full cycle on more than 20 full apartment assets, large apartment assets. So this is what she does. And she has an average annual return of 43% in all of her full cycle deals. So lots of background there. And then Madison is our full-time CPA that works with Faris Capital. So she makes sure that she is making sure that the distributions and all of the tax reporting comes in, the tax slips come in on time as well. So I'll put our team up against any other team in the industry when it comes down to strong operations. And everybody is full-time under the Faris Capital banner. And so that means that we have the time to be able to allocate to operational excellence. A little bit more about us. Currently, we have over 175 investors. We've deployed over 50 million in Canadian equity so far. We do work on both sides of the border. So from a conversion standpoint, we're at 50 million. We're at over 500 residents, and we have a big mission to place over $1 billion in equity to be able to get into apartments. We believe that apartments are the strongest way to build wealth. It's what the wealthy use. And so this is getting access to everyday entrepreneurs, very successful investors that want to do well, that just can't climb to that next level when it comes down to investing into apartments to be able to get all the upside of that. And you can see our core values on the right-hand side is how we make our decisions. So a little bit about our track record. So last year, earlier in the year, we had closed on 104 units in Tampa. And so it's actually Largo, just outside of Tampa. And currently right now, we are on budget for renovations. Our average rent lift on this is $312. That's above our projected rent lifts. You can see before and after pictures, and we are on track with all of our monthly distributions. So it's going extremely well. Actually, on this asset, we have a wait for our two bedrooms apartment here, and so it's going better than expected. You can see what some of these rent lifts are we're getting in our new units. When we turn out a new unit, we do the renovation and we bring new tenants in. I mean, we're getting on average over $500 rent lift on these new units that are converting over. Another asset we closed on is 144 units in Charleston, South Carolina. We got this at a large discount, and we're on track with our renovations, and the average rent lift on this is $350, and we're on track with those monthly distributions as well. You can see the before and after pictures. You can see, I mean, the rent lifts that we're getting in the new units that we're turning over is very, very high. Again, over $500 in rent lift across the new renovated units. And then Strawberry Station is an asset that we actually closed earlier this year. And you can see the before and after pictures of it. And we're on track with our monthly distribution, same with our budget as well. And you can see not only the new units, you could see over $350. We actually included all of the renewals. And so the renewals, what happens when we take an asset over, we don't just jack rent up to market value on that first year. On the renewals, we can see the lifts that we're getting from the under that first rent lift there. You can see at $350, and so the following year, in year two, then we'll bring it up the rest of the way. So generally, the business plan for us to go and raise rents is approximately about 2 years. But the new units, you can see the rent lifts when they move out, we can go right to market value, which in this case is above our projected rents. The market of Georgetown It is a quaint town. We actually went in and we had breakfast right in Georgetown, and it was just a really cool spot. And it's about 10,000. It's situated in South Carolina. Why we like South Carolina is it is the #1 growth state when it comes down to the U-Haul report. So one-way track where people are moving to. There's no, we'll say, rent control. There's no rent control when it comes down to raising to market rent. So there's no sort of restrictions like there are in other, we'll say, New York or California or Ontario in Canada, for example. Affordability is much greater there. Great quality of life. Lower tax rates as well. So state tax is very, very low. And it's a diverse economy as well. A lot of employment moving to this area. Georgetown is, there's a lot of people actually commuting into Myrtle Beach and Charleston as well. So it's more affordable, but it's a, we'll say, diversified workforce here. There is a lot of services here in healthcare as well. But average income is strong, and we really believe that affordability is such we'll say, a strong trait of this market that we're positioning ourselves really well as more people start to move into the area. So you can see here, very diverse when it comes down to it, and there's a lot of tourism. It's a very pretty spot, and again, it's a coastal city as well, which means that there's going to be continued demand moving forward. Here are the major employers. You can see the breakdown in employees and also the different, we'll say, from manufacturing, healthcare, education side of things. So lots of jobs in the area, which when people have jobs, they have money to pay for rent and they need a place to live, and that's what we provide them. You can see the property breakdown. Here's a summary. It's actually 67 units. We're advertising 66 because one of them we're using as a office leasing suite right now, but it is a full unit. We could easily convert that to a unit if we wanted to increase income. As for now, we're using it as an office. You can see the breakdown in the 1, 2, and 3 bedroom. And you can actually see, like, square footage, they're good size units. So they're not small. And so that just poses very well with the increasing the rents moving forward. Here are the floor plans. You can see the 1 and 2 bedrooms here. So they have great floor plans, and then the 3 bedrooms as well. So some of them are larger, 1,500 square feet. So that's fantastic. Business plan, you can see here, one of the big differentiating factors that we have at Faris Capital and why we'll say the business plan works really well for us is because we give before asking. We give before asking when it comes down to rent. And so the very first thing we do when we move in, we change out the property manager to somebody friendly. We want to install the Faris culture in, and it's really focused on providing a great resident experience. We go in and we offer 3 guarantees to our residents. So if they move in, if they're not happy within 30 days, they can cancel their lease. If we do not fix a maintenance request within 48 hours, we give them a concession. And if they lose their job or family death in the area, we do let them out of their lease. And so we tell new residents this up front, and it's a really, well, it's very well received. And so they know that they have, we'll say, surety coming into our building compared to going to a competition. And so for us, this is very rare that people will take advantage of these guarantees, but it holds us accountable to delivering great service. We go in and we do all exterior updates. We renovate the vacant units. In this case, it is actually 100% occupied right now. The rents are extremely low, so they fill quickly. So the existing owner has not been pushing rents. They're more so managing by occupancy. And then we do all the amenities in the area. So dog park, we're going to do a barbecue station, and this, I'm going to be talking a little bit more about that moving forward. We stage the leasing and renovate the leasing area, and then we do a resident appreciation event. Now, it is a 28-day plan, and it's a little bit of a deeper plan on this where it might go a little bit over the 28 days, but by doing this up front before raising rents, this is a key differentiating factor when you're investing with us, that you're, we'll say, providing a great experience for residents, not just going in and jacking up rents. And we find by giving first, people and the residents are much more receptive to receiving our rent lifts at that point. They like the community, they see the value that we've already delivered to them, so they can justify paying more rent. So in the interiors, what we're looking to do is a full gut job of the interiors. We have $15,000 per unit that's allocated. Now, we've already done this business plan on another asset in Charleston, just down the road. And so we're just rinsing and repeating with the same materials, the same contractor, and we're very confident we're going to hit that budget. The washer and dryers is something we're looking to install as well and implement and receive income coming in from those washer and dryers. On the exterior, we do have a roof budget that's allocated. We probably won't do that immediately, and we're going to be watching that to see how the roofs do when it comes down to it, because a lot of them are still in good shape. We're going to be doing some eaves trough work right off the bat, install a dog park, grilling station, new signage, and new brand overall. And so we're going to give it a very, great facelift, and we're going to be able to give to the community. You can see the before and after renderings of what we're looking to do. You can see the exterior on the top and then on the lower level there as well. This is rinse and repeat of another asset that we've done in Charleston. Exit strategy, we're looking at a 3-year renovation. So the whole period is going to be between 3 and 5. I could see us selling on the short end of that, on the 3-year mark. Go in, we want to raise net operating income. We want to, transition this property and reposition it for a turnkey operation for a high net worth investor to be able to purchase it and then just run it like clockwork. And so we're going to put in the work to make that happen. And so we're going to be monitoring when the best time to sell, and it'll be within that 3 to 5 year time frame. The financials on the asset here, you can see cash on cash returns. They start at the 5%, and then it ramps up to over 7%. It averages out to about 6%. You can see the equity multiple. We're looking to double the returns in 5 years. You can see year 3, we're looking at 21%, but in this case, we're advertising a 20% annual return. The break-even occupancy is really strong. So this just means that in year 2, for example, the building can be 77% occupied, and we're still covering all of our expenses. So we're not having to come out of pocket there. And so as the years go by and we continue to increase net operating income, that occupancy break-even comes down. Debt service coverage is very healthy. Year 1 at 1.39. Most lenders need it at 1.25. That's just your net operating income over your debt payments. So it's very conservative. Year 2, 3, and 4, 5, you can see it increases to get even more, safety in the deal when it comes to your payments. Now, we walk through all of the rent comparables as well. And we feel very confident in our rent projections from our 1, 2, and 3 bedrooms. So you can see what the competition here is doing, and we're very confident we can hit these rent projections. The sale comps, you can see what other buildings are selling for in the area, and you can see at $100,000 per unit, we got this at an exceptionally low cost basis. The financing terms, you can see we are taking out a $4.2 million loan. Currently, we've earmarked and underwritten for 6.11%. We do think we're going to be monitoring the treasuries, and we believe that we've been very conservative with what we've underwritten, and so there's a good chance that that number is actually going to come down by the time we lock that in. The 2-year interest rate only for the first 2 years allows for better cash flow as we're doing the repositioning. And so it's very low leverage in this deal. So there's just more safety there. Here's our 5-year pro forma for both income. You have all of our expenses, and then you can see our cash flow and the debt service as well. So we projected out 5 years. We actually go past that, but for the sake of this presentation, you can see these are our projections. Operating expenses, you can see per unit, and then our 1 year for all of our major expenses. So we're very conservative on this. And then the CapEx budget, we're looking at $1.686 million is what we're allocating towards the budget for the renovations. And again, we feel very confident we have enough, leeway and extra reserves to be able to easily hit this moving forward. Tax projections, we have hard tax projections that we go to Ryan Consulting, which is a tax consulting legal firm that is conservative with what they believe the taxes will be once we close on the deal. So we've underwritten that into the deal. And we do have hard insurance quotes as well. So not only does this cover the building, but it covers any sort of income loss that would happen if the residents, say, had to move over. Let's just say there was a fire or whatnot. So we're fully protected. We have an exceptional insurance broker that specializes in multifamily apartments. So we're confident that we're going to be able to deliver this because we have hard quotes right now. You can see the two different class shares that I've already talked about. But again, we have the 10% monthly cash flow. Now, this does sit above the Class B class share in regards to from a preferred return standpoint. So if you're looking for safety and more steady cash on cash returns, Class A is your option. We have 20% of the shares allocated for that, and the rest of them are for Class B, which gives you still an 8% preferred return. So that means that you as the investor gets the first 8% before Faris Capital gets anything. And then between 8 and 15%, 70% goes to you, the investor. And then anything above 15%, it's a 50-50 from there. Now, this is an extremely tax efficient structure for both Canadians and Americans. We have investors on both sides of the border. Okay. And so you get a T5013 tax slip at the end of the year. If you're a Canadian, you invest into the Canadian limited partnership, and those proportionate shares flow down to a Delaware limited partnership, and that's where our American investors invest into. And so our American investors will get a K1 at the end of the year, and you get all the tax advantages of each of the countries that allow and permit. Timeline on this, we're looking at it's first to fund. So June 15th is when we're looking to be fully funded, and we're looking to close on this by the end of July. Monthly reporting starts in a month after that, and then monthly distributions is pretty much about 3 to 4 months after closing is when we start, and there is a catch-up. So there's a catch-up from closing. So distributions will actually be from closing day, but we actually start those distributions about 3 to 4 months after. There's a catch-up, and then there's monthly distributions after that at the beginning of the month. So next steps moving forward is very simple to invest. First, you can fill out the reservation form. Once you fill that out, we'll send you the approval intake form, which is that's through our investor portal, which we will send to you as soon as you fill out that reservation. Once you fill that out, we do need to approve it. We need to approve you as an investor. You do need to be an accredited investor. And so accredited investor just means that you're either making $200,000 as an individual in annual income, or $300,000 between you and your spouse, or so it's one of the three. The third option is you have $1 million in investable assets outside your principal residence. And so those are the three steps or the three different ways you can be accredited. And so we just need to approve that for you. And then once you're approved, we'll let you know, and then you can send funds, and that's pretty much it. Then after that, we will keep you informed of what's happening when we're closing, and then the monthly distribution. So it's super simple. So this is built for busy entrepreneurs, busy, successful investors that don't have time to manage it, but they want to make sure that they have all the upside if the building does very well, and that they have a strong operations team running it. And so this is built for you if you are that investor or that busy entrepreneur. So in this deal, there's about 35 spots that are available. And so we are almost fully reserved on this right now. And so if you're listening to this, I want to encourage you to make your decision and actually take a step forward and fund on this sooner than later. By doing that, it just guarantees your spot in this deal, because once it fills, then we close this off, and then you'll need to wait for the next investment opportunity. So you can scan this QR code here, and that will take you to the reservation form. There'll be a link down below as well. But the order of communication is to anybody that made that reservation or current investors. They get first access, then to our database, and then we publicly advertise, which in this case, I don't believe we're going to get to that point. If we do, then it'll be first to fund there. So I really appreciate you guys listening, and looking forward to potentially investing with you guys. Hope you have a great day.